Good morning, good afternoon, and good evening, everybody. Hey, welcome to this episode of the Note Closure Show on Monday. So it's our Money Mondays episode here. Hopefully, you guys all had a great weekend, rock and rolling. I know that we did. We got to celebrate birthday of my nephew and had some fun. And it's good to be back. It was kind of a shorter week last week because we kind of took off last Thursday and Friday. But it's nice when you can do that and get rock and rolling. But today's episode, I want to go through something that people have asked about. Actually, we got quite a few comments on this during our 3-day workshop that we had a couple weeks ago, and I encourage you to get signed up for the next Note Buying for Dummies workshop. Can't remember the dates, but it's in about a quarter. Basically, if you go to notebuyingfordummies.com, our website should reflect the dates of the next workshop. And we've got some cool things going on. We're coming up on our 1,000th episode, which we're kind of pre-recording later today. We hit 1 million views on our YouTube channel on Saturday. So thank you guys for watching and sharing and subscribing. Hard to believe we hit that number. We've literally just about doubled our views in the last 5 months. And tells us we're doing something right, something that you guys enjoy watching because we had more hours viewed than we have had in a long time. So it's not just the short videos, it's actually the longer stuff. About the average viewer is watching about 11 and a half minutes of our YouTube channel per day, per time they come. So it tells you there's a lot of great stuff there for you as well. But I wanted to go through because Brian and Lisa Dill were on the workshop this past time. And I talked with him after the class, and he said these two case studies that we went through, one last week with the Toledo performing note, which was kind of an arbitrage case. And then this one here in South Texas, in Floresville, Texas, really had an aha moment, I understand it now kind of thing. And no, and Cord, thank you for asking. I have not done that because we are in the process of switching platforms to host that stuff for you, so it's able to do that. We're dealing with an issue right now where we've uploaded some stuff to YouTube for the things, and YouTube says it doesn't like a video or two, and it takes the video down. Well, I need to have that video somewhere that you guys can watch it without YouTube saying it violates, its policy. So we're probably going to upload it to Vimeo because I'm kind of getting tired of Vimeo, and we'll probably just trying to tweak some things. So we have them downloaded, but we have not uploaded the share link. We'll get that out to you. That's my goal, to get that out today or tomorrow for you guys. At least we can go. So literally right now, everything is downloaded. It's just a matter of being uploaded to a spot where you can get to ask everything that you need to ask or rewatch. You know what I mean? But thank you for asking, Cord. We'll have that on you this week. A little behind the ball on that since we took Thursday and Friday off. But anyway, today's episode is all about kind of that arbitrage basis. And I want to go through this case study of a deal that we worked through in the workshop. And people said that they really like the simplicity of our spreadsheet and kind of walking you through the process and help you understand how to evaluate these deals, how to look at the numbers simply without having to run everything through a crazy financial calculator. It's still good to do that. And I'll talk about when you really definitely want to do that, or definitely look at the amortization table of when you're buying a note. But these two case studies, one of them said, check out the Toledo case study. And this one is in south of San Antonio, in an area called Floresville, Texas. It's about 15 minutes outside of San Antonio on the south side, going down towards Corpus Christi. All right. Not a bad area, familiar with it, but it's a little bit more rural than, say, San Antonio or Corpus Christi itself. But anyway, let's dive into what we put together here for you guys so that you guys can understand how we're going through this and kind of going through the details. All right. So this is it. It's a arbitrage. It's a performing note arbitrage case study in South Texas. Now, a lot of people maybe not like some stuff so rural, and that's totally fine. This is a performing note. It was newly originated. We'll go through. It's on a mobile home too. It's on a 4-bedroom, 2-bath mobile home on about 0.8 of an acre. Okay. And it's not a bad, I don't mind the stuff, but to give you a bit of an idea, it's got good views. This is the exterior view of the property. It's in good shape. The person that was selling this sold it on terms. And so the listing price on Zillow and stuff like that shows a sales price of 75. And I'll talk about why that number bothers me a little bit as we go through the deal. That's really the one red flag when it comes down to it. All right, but let's go through. I mean, I'll show you some photos. So it's a nice looking property. You can see it's on just about an acre. Cut off a little bit of the bottom here. I mean, yeah, you've got A decent, mobile home to the backside. I mean, it's a lot of mobile homes around here, so it falls in line with comps. Kind of rougher, two single wides to the right side, but this nicer house on the left-hand side. It's still not in a bad area because I'm not the person living it, but I would not mind owning this property. It's on a decent piece of property. You can see it's got the slab here, maybe an old garage and stuff like that. This is an aerial view, so it gives you a bit of an idea what it looks like. It gives you, and I wanted to show you this area here. So just south of basically the 1604 loop of San Antonio on the way to Floresville. So it's in between San Antonio and Floresville. So it's out a little bit. That's pretty common in a lot of these areas going south down to like Corpus Christi or the Valley. But it's not like true Valley. It's closer to San Antonio than it is any other really big city. So let's go and pull up the numbers so you have a bit of an idea about it. Like I said, it was relatively newly originated. And here's the numbers. Okay. So make sure you guys can see my spreadsheet. If you're listening to this, you probably want to click on and follow along by watching the YouTube video. But anyway, they're looking, okay. So this is the great thing about this. They're trying to sell it at 125 and they're flexible. So let me go in here and change this to 125 and all my numbers should change. Okay. So originally they sold the property for $180,000 in owner financing. Okay. They were originally trying to sell it cash for 75. Somebody came off for owner financing, so they sold it for 185. The borrower put down about 15,000 down payment. So the originating UPB is 165,000. Okay. And they just originated this actually on my birthday, May 28th of 2025. So it's been around for 2.5 months. Okay. Now that concerns me a little bit because I would rather see at least 90 days, if not 6 months of season owner finance stuff. Now, they did say that they used our RMLO when they originated. Okay, so it should be kind of clean paper, and it's with a servicing company, if I remember correctly, like Allied, right? So they put a chunk down. They didn't quite put 10% down, but 8%, 9% would be interesting. Like I said, 165 is the UPB and some change. 12% interest rate on this owner finance note. Okay, it's a 30-year note. And the monthly P&I payment part of it is $1,697 a month. So just under $1,700 a month. Like I said, it's a 30-year term at 12% interest rate. So it's fully amortized, non-interest only, fully amortized. So it gives you a bit of an idea. That's a good chunk of change coming in each month. Now, the great thing is they're selling it at a price I think that makes sense. They're offering up at basically a $40,000 discount, basically at 75 cents of the UPB. And they were flexible on it. So let's just run the numbers on this thing. If you don't have the money, where does arbitrage come in? Well, this is arbitrage. Arbitrage is simply taking something that you can get at a lower price and selling it at a higher price. All right. So if you buy it at, 125, you sell it at 180, or you finance it, do some of those things as well. Now, the same thing comes in with us. We can do with arbitraging other people's money, right? So this is written at a 12% interest rate. Now, the fact that they want it cheaper than the 165 gives you that ability to bring in other people's money for the purchase price, right? So if you bring in $125,000 in other people's money, straight up buy it 125, the 10% interest costs at 8%. I mean, if you do, and what I've got here is money at 8, 9, 10, 11, and 12%. So you can figure it out roughly if you're just paying interest only, because you get a sizable gap. You got a $40,000 gap between what is owed and what you're buying it at. So that's going to take a little while, especially a newly originated note at 12%, for any type of principal to come down. You're going to have a while before you even get close to 125,000. Okay. But at 12% interest rate, and if they pay it for a while, I'd be willing to bet that maybe at some point the borrower is going to refinance you out. So what I did, I calculated if they refinance you out at 5 years, 60 months. Okay. You hold it beyond, that's fine. Let's go for that. So if you're borrowing 125,000 at 8% interest rate, and it means you're paying 10 grand a year in interest to your investor. That's $833 per month. All right. Now you're taking home $863.67. So you're paying just about 50% out to your money partners. Now, let's just take this number here. So let's do 1697, just so you have a bit of an idea. So 1697 times 12 equals 20 grand 364 per year. Divide that by your purchase price of the note, 125,000. That means it's about a 16.2% cash and cash return. That's why that 8% is almost halfway. The difference of $30.34 is that 0.2%, 0.3%, 16.3 if you round it up. Okay. Now, if you did it at 9%, you're paying out 11 and a quarter thousand. You're paying your investor $937.50 a month. You're taking home 759.50 cents. Okay. 10%, you're paying 12.5. A year, it's 1,041. You're still netting $655 per month. 11%, you're paying 13.75 thousand. You're paying out 1145.46 and still pocketing 551. And at 12%, you're paying out 15 grand a year, paying 1250 a month to your investment partner, but still netting 447. Okay. Now, if you take that monthly cash flow that you get to it on the low end side for the year at 12%, you still net 5,300 bucks, and take a little bit more. On the high side, if you're getting money to 8%, you're going to see, like I said, 863 a month. You're going to net $10,364 in cash flow, okay, for the first year. Now let's multiply it times 5 years. So that number, 8% now balloons. You've made $51,820 in cash flow if you're borrowing at 8% over 5 years, all the way down to just $26,820 if you're paying 12% on your money at 5 years. Now, your investor's making 12%. That's a pretty good ROI. I don't think you'd have too tough a time keeping an investor in a deal for 5 years at 12% interest. You know, maybe 3 years, maybe 4 years, stuff like that. But a lot of times, as long as they're getting paid on time, as long as this bar is paying on time, it's a rock and roll. But let's see the rates go down in 5 years. Somebody's been paying on this for a while. The value of this property plus 0.8 of an acre goes up. I would assume that because property in Texas is not getting cheaper, especially land. So let's just say it holds its value. Let's not even say it goes up in value. But let's just say it holds the value at 165. I'm sorry, at 180. Okay. Providing there's comps, that's the one big. We got to make sure that there's comps that justify the $180,000 value. If comps come back and says, no, it's only valued at 125, I'm going to offer less than 125, obviously. Okay. Because there's about a $50,000 jump between what it was listed for originally, 6 months ago to what they are willing to sell it at right now. So that's my big caveat, making sure that it's RMLO, it's a Dodd-Frank compliant loan. They've got a full financial package of the borrower, not just some rental software, making sure it's third-party serviced and going from there to justify that 125 purchase price. Okay. Now, once again, let's say the value just holds at 180. Let's say 180 or goes up. Well, in 5 years' time, based on an amortization table, 30 years, 12% interest rate, okay, their payoff in 5 years is only $161,144. It's only gone down by about $4,000 in principal reduction. Okay, just under 4,000. Actually, to be more precise, $3,816 in principal reduction. Okay, so they still owe a chunk. Now, if they refinance you out, if they go get a loan less than 12% interest rate, 5 years of seasoning, refinance that with cheaper money, which they probably could until it said 12%, you're going to net another difference of between what you borrowed and what is owed. Remember, you borrowed 125. It's at 12% interest rate to the borrower. You're paying out between 8 and 12%, okay, to your funding partner. Your net between what is owed on the note and what you borrowed at 125, well, that number is not going to change any, is $36,144. That means by arbitraging this note, you're going to make somewhere between $62,000 and $89,000. $62,000 is going to be the difference of it's going to be $36,144 is the difference of the payoff and the cash flow of $26,820. So by adding those together, it comes to just $62,966 in 5 years. That's pretty good. That's if you're paying at 12%. If your money is at 8%, obviously you make a whole lot more, $51,820 on the 5 years of cash flow from the note. And then at the 36 to it, that bumps it to $87,964 in 5 years. That's pretty good. That's a pretty good deal to arbitrage there, provided you can find $125,000 at 12% interest rate. Now, that's on the money borrowed there for you. Now, let's talk about, well, what if they don't pay? What if they don't pay and I got to foreclose? Okay. So, well, in Texas is a fast foreclosure state. So we know that you could probably foreclose in less than 90 days. Once they get 90 days late, then you're foreclosing in that county. You should be able to foreclose once the notice of default is filed 21 days prior to the first Tuesday. It's Texas. So you probably have to put some stipulation in here, was what I do. Said, listen, I'll give you 1 year, a prepayment penalty if the borrower defaults me to foreclose. Beyond 1 year, I'm not going to give you extra interest rate. But if they don't pay, we'll know usually in the first 12 months, right? So if you're borrowing 125 and you're doing 1 year of prepayment penalty interest at the 8%, okay, that's 10 grand. Okay. You figure $2,000 for foreclosure costs. That's about what it would take to foreclose here in Texas pretty fast. That means with a $120,000 purchase price, the 10% 1 year interest at 8% to your investor, it's going to be faster because it's not going to take a full year. $2,000 in foreclosure costs. You're now sitting at $137,000 total costs. Okay. That's what your cost basis is to foreclose. You foreclose, you didn't sell at the auction. Now you have a property that's worth $180,000 based on paper. Now, if that number doesn't pencil out, obviously, we know we're fading our bid and adjusting numbers. But it's just based on what they told us here, $180,000. Okay, you're going to take away 10% for closing costs and commissions. So at 10% of 180, that's 18 grand. That equates to a net sales profit of roughly about 162,000. That's if it sells at the peak of what it is. 162 minus 137,000 is what we have for our total costs. That means we're going to net 25 grand to the foreclosure. Okay, not bad, right? If it takes you 6 months to do this, to buy it and sell it to somebody else, because I'd be very surprised that you couldn't sell this acre and a 3.2 or 4.2 mobile home on an acre. If you offered owner financing on it, definitely could sell it pretty decent. But if you sold cash to somebody too, you'd probably, I mean, if they're making 8% in 6 months, that's a 16% cash and cash return for them. That's pretty good return for your investor if it takes 6 months to be in and out of the deal and they stop paying. Now, if it goes beyond that, there's no prepayment penalty. They're just can't pay back their interest plus the rolling interest that they're due that you haven't paid on a quarterly basis. All right, but that's not a bad return of 25 grand to foreclose. As I said, your numbers aren't going to lie to you. You're going to pull a BPO, you're going to pull comps, you're going to see exactly how they justified that $180,000 sales price. If it comes back and say, well, it comped out at 150, but since I'm the lender, I'm going to comp it out at 180 because I can do that. No. We're not going to do that. So then you would go back and fade your bid. I'm not going to pay, what is that? 86 cents on the dollar. So 125, so let's just do this. Let's say it came back 150, 125 divided 150. I'm not going to pay 83 cents on the dollar for a brand new note. I would want to see, yes, if they put some 15 grand down, that's nice, right? But we want to make sure that everything else, like I said, pencils out for you on this deal, okay? Questions for you. How would you market this? Well, you could do a text blast. You could do an email blast. Talk about the deal that you've got that, hey, you're willing to pay, the double-digit return or above-average return for somebody who has 125,000 and is not making anything. This is where the whole marketing to SDIRA investors really comes in handy in making it happen. Once again, the borrower's paying 12% interest rate, 30-year AM. It's about 2.5 months of seasoning as we sit as of today, as we record this. They have paid the 2 months of payments. It's in Floresville, Texas. And, you're going to make anywhere from $860 a month on an 8% interest rate, money, all the way down to 447, but that's still 447 cash flow coming in, that you have none of your own money tied into the deal. So it's an infinite rate of return either way you look at it. It's a good return to your investors passively, 3 to 5 years. Okay. Well, Scott, what happens if my investor wants their money out for 3 years? Okay, go find somebody else to fund the deal. It's going to be an even better deal at that point because you've got seasoned notes. Somebody's been paying on time. Their UPB is still going to be about 162, 163. And you're basically having somebody come in at 70, 75 cents on the dollar to refinance you out. It's a good day. And they are getting a great return and a passive return with third-party servicing in place. And you're not having to do anything in a fast foreclosure state like Texas. And I'd be willing to bet that, especially since this is a 8/10 of a lot, there's going to be more improvements done to the property. So the value should go up. It should be a much more stable asset than just a double wide, 4.2 double wide on a property. But people often like those types of deals, and it can be a good yield for it. I mean, literally, if you're paying this, like I said, it's going to be about, if you bought it as is and used your own money, 125, it's about a 16.2, 16.3% cash and cash return to you. Okay. Questions, comments, concerns for you guys that are out here? I think you should be able to type in the chat roll. I believe I allowed it, so you're just asking questions. Yeah, yeah. Does these types of deals scare you? You know, gives you an opportunity to look at some stuff for you. Albert, Cord, Fernando, Tanya. Those of you guys that are joining me live on here. I know, Albert, you're working on your first non-performing deal. Did you reach out to Faye besides just an email, but pick up the phone and call her? I know Albert's working on his first non-performing note deal, which I'm excited about. I mean, the way to find these deals, you know, look, if you're targeting owner finance sellers or people of owner finance stuff, this is exactly kind of the deal you would do. You know, see if you can buy it at a cheap enough price. And that's the thing of going through so much or targeting stuff for that aspect of things. But we do the same thing in the non-performing stuff. We're buying that note at such a bigger, cheaper price, getting them back on track and using other people's money to come in and fund the purchase at 8 to 12%. It's kind of the same thing, but this is just somebody's brand new. So the risk on this one is it's newly originated, no seasoning. You know, you hope the borrowers will stay on track. I mean, the fact that they put 15 grand down usually means they've got some emotional equity in the deal too. All right, property is in good shape based on the other interior photos that we saw. I won't share with you guys here, but it's a pretty good, yeah, I think it's not a bad little deal there. If you've got 125 grand in your own capital, or you got some investors that have 125 grand, which we, you know, if you're just targeting IRA investors, that should be something you should see. You know, somebody asked, well, Scott, can I pull two investors that have 60 grand and 65 grand together? No, I would not do that. Wouldn't pull them together. Have them create an LLC if they know each other and have them partner together on this deal. But I do not pool money. That's a bad thing to do. Okay. And like I said, provided the value is there, the true comps. So you're going to order a BPO, you're going to order title, you're going to review the collateral file like you would anything else, making sure it's up to date, Dodd-Frank compliant. Look at the borrower's financials. What do they do? You know, what kind of income is coming in? You don't really want to be above 40, you know, 50% DTI, debt to income on it. So hopefully the person that owner finance pulled a credit score. Now, if they don't have a FICO score, maybe it's some of the Visa. So look at the debt to income. What do they have coming in monthly? And what have they going out for the property? Total expense is important to do that. Okay. And that should be in the RMLO file. If they didn't use an RMLO, they're self-servicing it and they're not using a service software like Terra Notes or something like that, you got to fade that bid down because it's not as good a clean paper as you would hope it would be. All right. So no questions, no comments, no concerns, guys. Cord, thank you so much for checking out the AI bot. I encourage you all to go check out the clone. Delphi.com/Scott Carson is the website for you. Let me pull it up here so you guys can take a look at it. It's kind of a cool thing we worked out. We're messing around with it. We encourage you guys to go over there and ask questions. Let me upload this here, so share my screen so you guys can see it. We shared the link in Basecamp for you guys, but right now, since it's beta phase, we want you to go ask it questions. And it's designed as be a tool for you guys so that you can go and ask questions 24 hours a day, 7 days a week, you know, if I'm not available to schedule a phone call. But it's pretty good stuff for the most part. I'd say there's a few tweaks I'd make to it, and that's why we're in the beta phase for it as well. But go ask questions of it, tweak it. We're making a few adjustments to the access levels here for you guys. If you're part of Basecamp here in the WCN membership, you should have full access to it. It's the outside folks, and we're still letting it open up for a little while before we kind of start closing off a little bit as it becomes a bonus for our students is what we really want to focus on. But it's there to ask questions, how to find deals, how to fund deals, other deal scenario questions. We're uploading some spreadsheets with case studies and numbers behind it, trying to help it get in the habit of answering questions on actual case studies too, if it makes sense. That's a lot harder than just uploading, you know, videos and blogs and 5 million words of what I said over the last 15 years as a note investor. But it's designed there to help you. Once again, that website is Delphi, DELPHI.AI.com. Delphi.ai/Scott Carson. Check it out. Love to get your feedback. If it answers something weird, I'd love for you to take a screenshot and send it to me. Actually, I don't need you to send a screenshot because I can look at every conversation that people are having. But just let me know, and I'll be glad to get in and tweak it And we are here to help you guys. We're excited. Thank you again for us helping hit 1 million views on our YouTube channel. #1 YouTube channel for note investing. We've hit well above 1 million downloads of the podcast. So thank you for that as well. And thank you for being here. As always, we're excited for what is going on in the market and the next 1 million views, the next 1,000 episodes of the podcast, and to help you really take your note business to the next level, everybody. So from the bottom of my heart, thanks again. If you have any questions, feel free to book a phone call with me, talkwithscottcarson.com. We're always here for you. Otherwise, check out the AI clone and see what answers my clone can give to you today. So go take some action, and we'll see you at the top, everybody.